Dipen Sheth, Head-Instl Research at HDFC Securities, joins us now. Morning, Dipen.
Morning.
Are you getting a sense that the texture of this market has taken a huge knock? I mean, we have some of the experts telling us that it will take a while for people to buy into this rally. Are they likely to see rallies as excuses to sell?
Lata, I think we need to zoom out of this situation and isolate or separate, as it were, the market phenomenon from the macro phenomenon, because right now it's all macros and it's China and the world slowing down and commodities going for a toss and so on. So we are using a lot of macro arguments to justify the shocks that the market is riding through. To our mind, we are not macroeconomists, but the big picture is inescapable here. And that is that after years of a liquidity fueled binge of sorts in China, there is very clearly at least half a hard landing. And that realization has happened late, as it were. After years of strong commodities, globally commodities are in a major sell-off. And both these factors, counterintuitively, if you dive deeper into both these factors, you will arrive at bullishness for India.
Okay.
So the fact that markets have sold off in India is part of the larger global momentum trade which is played out, and obviously India is subject to global liquidity flows, and so to my mind, this is a technical sell-off in what is fundamentally a long-term bull market in India, because the long-term bull market is premised on precisely the facts that form part of the shock treatment that the world is going through right now. And those long-term effects are as follows. One, that commodities are softening. Two, that global growth has softened, but parts of the globe which at least determines India's export earnings is actually resilient right now. So whether it's the US, which published very good data, the second quarter revised data, as it were, the upgrade there, and the slow coming off from some kind of a bottom for Europe. I think both of these things augur very well for India's export-oriented industries. And softer commodities, we've been saying this for donkey's years. You don't need to be an economist to figure out that India's import dependence on commodities is something that will stand it. Actually, it's what used to be a liability is now an asset. So what's the problem? This decline has to be bought into. You can't buy this market for what it's going to do today or tomorrow. We are not options and futures traders. We are giving you fundamental advice here, and the advice is that this is yet another crack in this bull market which will get you a chance to buy.
Okay, now in this set, you obviously are going to avoid stocks which could be affected by a China slowdown perhaps, or further news of China slowdown. Can you isolate some stocks which are most vulnerable?
Yes,
commodities.
The broad call on India is positive, but you do have to take cognizance of the fact of the selective pain that is there in some of the global markets or in some of the global economies. And you also have to take into cognizance the fact that you do have things in India, whether you like them or not. You do have businesses, sectors, companies, etc. in India which are connected with what happens in China. So for example, the global cyclicals. So the steel guys are in for trouble, and you don't need me to tell you that all over again, right? So the exposures to steel companies are already.
So you avoid materials.
So you avoid materials altogether. Now it doesn't mean that there aren't any good companies in the steel sector worth chasing, but they are going to be under increased pressure, and there are going to be better opportunities elsewhere where you have a pure play India. So you know, this last note that we brought out where we symbolically wrote India greater than China. It's obviously not a larger economy than China, but it's certainly going to be a more interesting and investment-worthy economy over the next few years, I dare say. And the way we pitched this story to clients was that elephants can fly when dragons can sneeze. Okay. So it kind of captures a very long message in one sentence, that here's an elephant which has parts which can fly, even as the dragon is sneezing.
Okay. And yes, you've identified 26 stocks with low vulnerability to dragon sneezes and high alignment to elephant flight. So let's talk about that. You know, what's most interesting is in every sector you've picked out leaders. So for instance, you've got a Maruti in the auto space. In the IT pack, you've got an HCL Technology. But in the infrastructure pack, you've gone with mid-caps. You've selected a KNR Construction as not a PNC Infratech. You know, conventionally we were, taught to believe that if you, not taught to believe.
So L&T is the big proxy.
L&T or BHEL are going to be the big proxy.
So sure, L&T remains a proxy. It's just that, at current prices, is the upside more attractive for me in KNR? And KNR's, I think, tripling or is it quadrupling of order book over 2 years, is that something likely to play out at L&T? Certainly not. It doesn't mean we are negative on L&T.
Okay.
But in a relative sense, there is more value here. And if you look at the way, the reason, this is a little bit of bottom-up combined with top-down.
Okay.
And so the top-down story on L&T is beyond question. Okay. I'm not denying that one bit. But if you look at the working capital cycle of KNR and you see how they and this is actually the stumbling block for a whole lot of infra companies or EPC guys.
Okay. There's another message that the market is giving now.
Yes.
The private sector banks have suddenly broken down. I mean, Rima was pointing it out. It just stares that it's not quite been able to be the leaders that this category was a few months back. And yet you have Axis Bank, okay, you also have Bank of Baroda, but we'll come to the public sector separately. Axis Bank, DCB Bank, Federal, IndusInd. Private sector banks, at least Axis, has seen a fairly big breakdown, as has Yes.
So again, the argument for India is the argument for Axis Bank. It's seen a breakdown, so hence it's attractive because not much has changed.
Why would it
I wouldn't look into price. So here is the trap that we fall into. That when prices fall, we think that something is wrong with the business. Part of that is typically true over an extended period, but not at times of shocks like this. So remember that private banks were over-owned with large FII exposures. And yes, if you look at the chart of Axis, you will see that it's obviously got more beta. So I don't want to tread into technicals territory here because strictly I have much lower competence there than whatever low competence I might have on fundamentals. Okay, so the thing about Axis is that it was over-owned, it was a darling stock, and there are so many good things for the bank. And if you look at, so let me refer to my cheat sheet here and actually quote from there, okay? So the thing is that over the last 3 years, this bank has consistently delivered positive surprises across parameters, okay? So whether it's the retail book growth, whether it's the NIM strength, whether it's asset quality, and hence everything lands into earnings. Now we think that this is the direct outcome of a capable management which is working overtime in a very difficult environment. Something that you also see reflected in DCB. Okay, on a smaller scale. So when good guys go through trouble on the markets, what do you do? It's time to buy. So do they have no exposure to infra? Of course not. Do we think that there is a little bit of an overhang on asset quality in Axis? I guess so, but it isn't yet reflecting in the reported asset quality that it's showing. The percentage of infra projects in which, you know, let's say power plants are already operational and so on is much higher for Axis. And also the one-time gains that they got from overseas, they've used it to create a buffer or a contingency reserve. We think now, and we can go wrong here, but we think that stressed asset formation has actually peaked out in F15 and it will only get better from here. This is a very capable bank, completely aligned with India's growth story, and actually a bank which has built out granularity not only on the liability side but on the asset side over a period of years. Now these so many years of hard work is now reflecting in very good reported numbers, and I don't think this story is challenged just because somebody is selling the hell out of China and moving out.
Okay. In the next 12 months, considering things could be a little volatile and uncertain, which sectors will give you leadership? Will it be IT and pharma over something like a financials from a 12-month perspective?
Actually, you've betted on cement as one of your growth stories, though prices still are very difficult. I mean, all the cement producers tell us capacity utilization is what, 60%, prices aren't rising.
No, it's not 60 throughout.
No, it's not.
So it's the south where capacity utilization is challenged, and the south has seen pricing coming back, and so the jury is still out on whether, you know, that's a result of collaboration.
So you won't buy the south companies?
No, it's not that we wouldn't buy the south companies. In fact, underutilized capacities down south actually point to hidden operating leverage if the cycle were to turn. But here's the larger argument on cement, Lata. Irrespective of what happens in China, and even if China becomes a low-cost producer of cement and it manages to produce cement at half our costs, there's no way they can lug all that cement into India and sell it at 4 rupees a kg or thereabouts. This is not a commodity which is global by any stretch of imagination. No. You have global majors in India who are consolidating and who are realigning their businesses. So whether it's Holcim, Lafarge, call it what you will.
So why Orient, Sanghi and Ultratech?
So again here, so Ultratech is the headline guy. So valuations at somewhere around $200 are not very, or 180 after the fall, or 180, 185 after the fall, are not very attractive. But if somebody has to notice that cement is a sector where you are safer off in India and not going to be subjected to Chinese tremors, then the natural stock to buy will be Ultratech, and of course Shree, which we haven't mentioned here, because in Shree again the valuations are north of 200, and it didn't really crack in this sell-off.
Okay.
Not as much as we would have aspired it to, you know. So that's resilience. And for me, Shree is as good or as great a company than Ultratech, if not better. But right now the price point for Ultratech makes sense. And then on the smaller caps, of course, you have valuations $100 or less. So you can't let go of those.
Okay. He also likes Sanghi Industries as well as Orient Cement in the cement sector.
Right.
But let me come back to the earlier question about it. From a 12-month time horizon, which sector will provide leadership? Will it be IT and pharma over something like financials, considering we're entering volatile times?
So the context again, Rima, is that we are looking at times when global liquidity flows are going to be challenged, at times when the Chinese tremors or sneezes, if you will, are going to provide small shocks from time to time. I would look for domestic stories, which is one big theme. I would look for, and these are old themes. I'm not telling you anything new. It's just that these themes are relatively protected or isolated or insular compared to the
Asian
shocks.
paints and the
So the domestic stories, especially when fueled by cheaper commodity prices and high pricing power. So it's not that Asian Paints is not going to lower prices, but it's not going to be in proportion with the raw material crack that they'll face. And Pidilite is another example. So there's one theme, domestic and subject to lower commodities. So Gulf oil, lubricants, not Gulf oil, by the way.
Okay.
So Gulf oil, lubricants, Castrol for that matter. And these are stocks which I haven't explicitly mentioned here, but it doesn't matter. There's another theme, which is that you have the India capability theme, as it were. So IT and pharma naturally stand out there. And the end markets now are actually less challenged than what they were 2 years ago. So in fact, the euro is strengthening. The demand environment in Europe will hopefully get better. It's already better than what it was 6 months ago, and it's likely to get even better as we move forward. With a strong euro, the demand environment improving in Europe, some Indian companies who are showing increased capability of capitalizing on the digital transition. So you look at a Mindtree in the mid caps, you look at an Infosys which is going through a multi-year resurgence in internal curing and market alignment. You can't let go of these capability stories. In fact, if you look at manufacturing in India, something that we always get very defensive about, you have a world-class story like Bharat Forge, which is now staring at hopefully better demand in Europe and the US, which are its key export markets, and also a cyclical CV uptake in India, which we are getting increasingly impatient about why it's not happening, but it'll happen over a period of time. And you have some great stories like this.
Out of time, Dipen. Thank you very much. I know you're not out of ideas, but thank you very much for joining us with that bunch of 26 plus stocks that the markets should look at.
You can call them the special 26 or whatever.
Oh yes, special chubbies. Good one.